In this lecture, we're going to look at the last topic in AC571, which is really around two disclosure standards. IFRS 12, which was kind of the catch-all disclosure standard for consolidation. And then we look at IAS24, which is the disclosure-based standard around related party transactions. So the last session we did was IAS7, and we said that was kind of split into two sections. Number one, recapping single company statement of cash flows. And that's coming from your undergrad studies. Just make sure you know how to approach it, how to calculate the answer, i.e. the movement in cash and cash equivalents, and then also the key sections in a statement of cash flow question. Your operating activities, your investing activities, and your financing activities. And as well as that then, I suppose the added complication we have when we do consolidations is we have to figure out how does the NCI, the associate, an acquisition of a subsidiary or disposal of a subsidiary impact the statement of cash flows. And that's kind of the standard that you should expect in terms of exam questions coming from statement of cash flows. So what we're moving on to the first standard today is IFRS 12. Now IFRS 12 was issued in 2011. That's when IFRS 10 was issued, the new standard for consolidations, which replaced IAS 27, and also IFRS 11, which was around joint arrangements. So all of these came as a package, and essentially what IFRS 12 was is, in IFRS 3, IFRS 10, IFRS 11, there's no mention of disclosures. What the standard body did was they left all the consolidated related disclosures to a single standard, IFRS 12. And essentially under IFRS 12, you have to give all your disclosures around what interest you have in other parties, i.e. subsidiaries, joint arrangements, associates, anything like that, and you have to disclose each of them. And that's where IFRS 12 is coming from. So you must disclose the significant judgments made in determining whether you have control. And we've shown you that with Glanbia before. They have to justify why do you think you have control if you only have 49%. Or in some cases, Glanbia had 51%, but they only said they had significant influence, i.e. that it was an associate. So that's what IFRS 12 covers. It says you must disclose what your holding is and your rationale for treating it based on whether it's a subsidiary, an associate, a joint arrangement, etc. So it's kind of a catch-all standard. So in terms of, for example, subsidiaries, they're all the list of things you have to give. The composition of the group, the NCIs that are involved, so what percentage holding you have of each subsidiary, any significant restrictions in terms of shareholder agreements, the risks involved, and any changes in ownership during the year. So there's quite a lot of detail, and what you'll usually see is one of the last working or notes in consolidated financial statements, they give all the list of subsidiaries. So if you look at Glanbia, for example, note 39, which I'll bring up just briefly, towards the end of the annual report usually. So note 39 there, go back. So note 37 related parties, we'll come back to that there. Note 39, principal subsidiaries and equity accounted investees. This is all coming from IFRS 12. Look at all their subsidiaries and they have to say what it does, where it's registered and what ownership it has. Same when you come to all the Irish ones, they've all the US. So they don't have too many ones with NCIs in them, but look at the number of subsidiaries that they have to consolidate. And a lot of them are foreign subsidiaries, so you're going to be dealing with IAS 21 there as well. But all of that is coming from IFRS 12 disclosures. And when you come back as well, you can see all the entities, and as well as that, they're disclosed in a separate section B, all the joint ventures in Ireland, 50% or 40%, United States, etc. as well. So there's a lot of key detail here. And you see the way the group has no significant restrictions, and the group interests are subject to restrictions but not material. That's coming from the requirement you must disclose any significant restrictions. The model financial statements do the same note, and what I like about the model financial statements, if you are going to use them, so note 21. So note 21 there. Now, when the model financial statements are very generic, there's no numbers, but look in the left margin, there's all your IFRS 12s. So they're saying this is why we're disclosing all of these. IFRS 12 particular paragraph is requiring it. The next page, all your IFRS 12s as well. So that's a nice thing about the model financial statements. If you control an F, so you control F IFRS 12, it will find all the relevant sections of where it's been used. So I'll show you a real world one, Glanbia, but you can also see a more theoretical one, but all the possible disclosures that are required as well. Same logic for associates. You have to do the same disclosures. like we see in Glanbia, and you can see the model financial statements, they just split it out. So if you go back to the model financial statements, they go the next note, note 22, there's your associates, but it's all under IFRS 12 again. Note 23 is joint ventures. So we go down here. See there, again, it's covered in IFRS 12. And note 24, when you come down to it, we didn't see any of these in Glanbia because they don't have them. In note 24, joint operations as well, where you don't actually have a separate entity, you have a joint operation. So it's just to show you these are quite important, and every PLC company will have IFRS 12 there. There's no actual accounting, there's no debits and credits. It's merely about the presentation of disclosures. So if you're ever asked about consolidation disclosures, the single guidance will be one standard, IFRS 12. The other key standard in this section is IAS24. Now again, this is a disclosure only standard, but it's a quite important one called related party transactions. I suppose the whole logic here is to make sure we have enough disclosures for the users of financial statements to understand if there's been any, well, number one, if there are related parties and what transactions take place. So there's an important logic of this, because otherwise, if you're looking at a set of financial statements, you automatically assume the user of financial statements that all these transactions are on a commercial basis. There's no unfavorable or favorable transactions with any particular parties. For example, selling goods at a discount or giving assets away under their market value. So there's a whole logic here. Why do we need them? Because they're a normal part of business, but you want to make sure you understand, well, are those sales all at what we call arm's length? Are they all at a commercial market value? Or did you make sales to particular people at below market value because they were a related party, because it was the wife of the owner, the husband of the owner, or because there was some link, personal relationship or whatever relationship that made you sell an asset at below its market value or whatever. So you wanted to make sure, can you quantify the impact of those related party transactions on the financial performance and position? Because otherwise it may give a false pretense that actually these sales are a lot bigger than expected or a lot smaller than expected because of these related party transactions. Right? So to figure out then, what we're trying to look at is the users need to be aware of the transactions. They need to know who is the transaction with, how much was it for, and what influence will that have. And that will include outstanding balances at the end of the year and also commitments. So for example, loan guarantees. One company could give a guarantee for another related company, but that could dramatically change the financial outlook for the business. So even though there's nothing on the balance sheet, a loan guarantee could be a significant liability that's not recorded. So the scope of IAS24 then looks at who are the related parties. So how do you identify who's a related party, who isn't? And you can be a related party as an individual, or you can be a related party as a company. So we should look at those two differences. We'll then look at what are the transactions and what are the types of disclosures that are required. And remember, these apply both for consolidated financial statements and also separate financial statements. So if you're doing a normal individual IAS1 company set of financial statements, IAS24 is relevant as well. So it's quite an important standard in the broad disclosure arena. So who are related parties then? It can be an individual person or it can be an entity. And this is important, and it's separated the IAS24 standard itself into two parts. Part A looks at which individuals are related parties to a company. And then part B looks at which other entities are related parties to this particular company. So we'll start off then with a person and we'll move on to other entities then. So a person, now we'll leave close family member for a second, but a person is related to a reporting entity. So we'll take company X. So you are related to company X if you have control or joint control over the company. Now that should be straightforward. If I own 60% of the company, I'm a related party. So any transactions I do with that company, I take assets out of the company, I sell assets to the company, I buy from the company, I sell to the company, all of that must be disclosed. Because otherwise I could influence what price it's at, and it could be artificially high or artificially low. If I have significant influence, for example, I own 30%, I'm also a related party. Or if I'm a member of key management personnel, that means if I'm a director or one of the CEO or CFO. So usually those people in the C-suite, Chief Executive Officer, Chief Financial Officer, or any board of directors. member of the board of directors. So if I'm a person with any of those characteristics, I am a related party, and any transaction I must do, I must disclose. But look at also that's in this requirement is anyone of my close family. And this is kind of a catch-all one. You'll come across this in tax anti-avoidance. This is kind of anti-avoidance for financial reporting, is saying, well, one way to get around is say, well, actually, I don't do the transaction. My wife does the transaction, or my son or daughter. So you're still getting the same transaction, but the fact is, if this requirement of close personal family member, this catch-all requirement wasn't in there, you could avoid IAS24. So the point is here, a close family member is anyone who expects to be influenced or influence that person. So your children, your domestic partner, children of a domestic partner, dependents, etc. So your wife, your husband, your family members, even your parents might all fall into there. So you're essentially seeing the person and their family unit as a single reporting entity, in that if any one of those people have transactions with the company, so you sell something at an undervalue to your son, or you buy something at an overvalue from your daughter, all of that is a related party transaction and must be disclosed. So if we didn't have those provisos about close family membership, it'd be very easy to circumvent the requirements. And key management personnel then generally are the board of directors, including the CEO and the CFO. They're generally the main ones. There can be exceptions, but the key point is if they're involved in the planning, directing or controlling of activities, and that's usually the board. So try and give you a bit of a visual here. So a person or any one of their close family members, if they either have control over the company X, they have joint control, significant influence, or their key management, they have a related party relationship. And any transaction, the payment of wages, the buy or selling of assets, the buying or selling of goods, the providing of loans, the providing of loan guarantees, anything like that will have to be disclosed. So it's relatively straightforward when you look at an individual person. The only small complication would be watching for the close family members as well. When we get to Part B, slightly more complex. Part B looks at entities that are related to other entities. So not people related to entities, other companies related to a company. So you can have transactions, of course, between companies as well. So we say here the rules in Part B is an entity E is related to reporting entity. So we'll say reporting entity, we'll call this company X. So entity E and company X, if they're members of the same group. So that means if they're both subsidiaries of the same group, one is a parent, one is a subsidiary, any combination of that, they're related. So any transactions between them individually, between a parent and a sub, or between two subs, they're related party transactions. If entity E is an associate or joint venture of the reporting entity, or of an associate joint venture of a member of the group. So for example, if entity E is an associate or joint venture of company X is the parent, or for example, if entity E is an associate or joint venture of someone else in company X's group. So company X might be one subsidiary, and then the parent might have the associate entity E. So an associate and a subsidiary of the same parent, they will be related parties as well. If entity E and company X are both joint ventures of the same third party. So one third party has a joint venture E, and they have another joint venture, company X. Then E and X would be related parties as well. So you see, it gets a bit more complicated when you get to entities, trying to look at all these permutations. If entity E is a joint venture of a third entity, and the reporting entity, company X, is an associate. So if you have one communal third party, has a joint venture and has a separate associate, that joint venture and associate are related parties. So any transactions between them must be disclosed. The entity E is the defined benefit pension scheme. So your pension scheme is a related party of the company. So any transactions would have to be disclosed. And also this catch once twice in bold, if entity E is controlled or jointly controlled by a person identified in A. So what we mean by that is, if one person controls E and controls X, even though they're not in the same group because they're owned individually, they'll be related parties. And we'll see that in a second. So for example, if your wife owns entity E and you own entity X, by definition that you're your husband and wife are seen as the same person in IAS24, they are related parties because there's communal ownership. Even though they're not in the same group structure, because there's no communal parent, they have the same owners in the eyes of IAS24. So we'll just show some examples. It's probably the easiest way to bring it down, but then this is all about disclosure. So an exam question, you might have to say, are these related parties? And you might have to figure out what has to be disclosed or what doesn't have to be disclosed as per IAS24. So take this example where you have a group structure within the boxes, parent and 2 subsidiaries, and you have 2 associates who are associates to the group. So if you look at this, for the parent's separate financial statements, all sub A, B, associate 1 and 2 are all related parties. So any transaction the parent does with any of those must be disclosed. For subsidiaries A's financial statements, they're all related parties as well. Right? So if you're subsidiary A or subsidiary B, you're related to your parent, you're related to the sub, and you're related to associates of a communal parent. So by definition, any transactions you do with associates or other subsidiaries, they have to be disclosed in your separate financial statements. The only one that's not related here is if you are looking at the financial statements of associate 1 on their own, associate 1 is not related to associate 2, and vice versa. So if you're preparing the financial statements of this entity alone, any transaction with associate 2, because there's only significant influence in that is commonality, they are not have to be disclosed. So that's a tricky one to watch out for. All right? And then the consolidated financial statements, they're all related to the group as well, because they're all either associates to the group or subsidiaries. So there's a bit of trick involved, just important to go back over the examples and the question pack as well. So this example where you have an investor, 2 different joint ventures, and 1 associate. So in the investor's separate financial statements, they're all related parties. They're related to JV1, JV2, and associate. If you're preparing the financial statements of JV1, you're related to JV2 and the associate and the investor. Because you're another joint venture of a communal third party, or you're another associate of a communal third party. Same for the associate and same the consolidated financial statement. So in this case, they're all related because there's either joint control or significant influence. The only one exception you always have is if there's only significant influence in both, they won't be related parties. If there's joint control or control in either one side, you will have a related party. So for example here, Mr. X, an individual, not a company, has an interest in entity A and entity B. Well, what is important here is how much does Mr. X own of both of them. So now this is a bit wordy, you'll see here, oh well it depends, and this is where it's coming from the paragraph B and each, and that's quite dense. The easiest way to look at it is look at the table. If person X owns both of them, controls them, then A and B are related because there's joint control with a third party. If there's joint control, then yes, because the same person has joint control over both. If there's joint control in one side and only significant influence in the other, it's still a related party. As long as there's control on one of them, there's deemed to be enough of influence to be deemed as a related party. But look at the last one. The only one where it's not deemed to be related parties is where X only has significant influence both sides. So it's probably easier to remember the one where they're not related parties than the ones where they are. So if your Mr. X only has 20% holding in A and a 25% holding in B, IAS24 says you don't have enough of influence to warrant these related parties because there's enough outside influence in A and B, so there wouldn't be any unusual transactions taking place. Same happens, for example here, Mr. X has an interest in A, whereas his domestic partner, Miss Y, has an interest in B. For all intents and purposes, when we look at the table, these two will merge. They're seen as the same person because Mr. X and Miss Y will be seen as close family members. So in that case, the table is the exact same. The only situation where A and B will not be related is where both X and Y only have significant influence. If there's any side that has control or joint control, then they will be deemed related parties. And any transaction between A and B, even though they're not in the same group, even though they don't have the same owner, will have to be disclosed, by definition based on IAS24. So there is a good lot to learn there, but I think the key principle, you're nearly better off focusing on who are not related parties than who are. Some other common ones that pop up in exams of companies that are not, or entities that are not related parties, two companies just because they have common director. So just because you have a common director, which often happens where one person sits on the board of two, they will not be deemed, just because of that, to be related parties. Two joint venturers who share joint control over a joint venture, they are not related parties. So if you have two companies who set up a joint venture, they are not related parties just by that. They have to have other reasons to be related parties. A bank, provider of finance, a trade union, or government department, they are not a related party to the company. Or any large customer supplier, just because they've large transactions, they are not a related party. So IAS24 is very explicit on the exclusions they have as well, and they're often the easier ones to focus in on. So the transactions themselves then, any transfer of resources, services or obligations must be disclosed. And the assumption here is, this is an important term, you're assuming the transactions occur at arm's length. That means you assume they occur at market value prices. So you're selling goods at their market value, you're selling or buying non-current assets at their market value. If they're not, it must be disclosed. Right? So they must, users of financial statements must be made aware when you're buying or selling assets at below market value or above market value with related parties. Because otherwise your financial statements are going to be misleading. So if you're selling or you're giving an asset at a free asset to your son, that has to be disclosed in IAS24. Right? Or you're buying an asset from your wife at above market value to allow to take cash out of the business, that must be disclosed in the financial statements. So it's quite an important standard. It has no journal entries, but it has an awful lot of important disclosure requirements. So what types of transactions must be disclosed? Sale or purchase of goods or assets, provision of services or receipt of services, any leases you have. So you might be leasing a warehouse from your son. You might be leasing a warehouse from a related company. Provision of loan guarantees or provision of loans, or settlement of liabilities. So if you settle a liability on behalf of a related party, you might pay off a loan for them, etc. That has to be disclosed. Or you might write off a loan. All of that must be disclosed. So your disclosures then, it's meant to supplement the other disclosure requirements, but it is an important one in itself. So if you look, for example, in Glanbia, in page 194, they tell you what the related party transactions are for the year. See here, they talk about transactions with Glanbia Cooperative, transaction with subsidiaries, and they talk about transactions with equity account investees, i.e. with joint ventures or with associates. So trades in normal course of business, they have certain agency agreements in place. The commission income receivable is included in sales services. So essentially for all of these, they get commission in. So they get commission in each year from these joint ventures or associates, and they disclose the amount. Likewise, they have transactions with subsidiaries during the year, which they have to disclose. So it's important to understand that's a key requirement that must be disclosed. I'll go back there. And what you'll also see down the bottom, in the next page, loans to equity account investees. How much loans are you giving to joint ventures during the year, and what interest did you earn on those loans? And another key disclosure, key management personnel. The board of directors are deemed to be key management personnel. And in the normal course of business, the key management personnel are, in this case, connected parties who are involved in farming activities. So they've said who it is, and they'll give you the number of sales, purchases with all the different related parties. You see this significant volume of them depending on what happens in the year. So there's a lot of disclosures going on there that are required under IAS24. And you can see you give purchases during the year, split across each of them, and they give the year-end balances at the end. How much is owed for each one. And the final thing that must be disclosed here, which is a requirement in IAS24 explicit one, is key management compensation. How much you pay to your key management personnel and in what form. So we can see that there, salaries, post-employment benefits would be pensions, share-based payments, and non-executive director fees. And they actually describe it then in terms of transactions to and from directors as well. Now, a lot of the time, these wouldn't be as popular in other companies. The reason a lot of these probably are farmers, where they're buying and selling milk off them as well. So that's why it might be only 3,000 or 5,000 in terms of sales and purchases that are going on at the balance at the end of the year, or the sale or purchase of milk. So that's what usually happens in a lot of these times who are involved in farming activities. So that's what generally happens. But you see the level of detail there. Every director, the sales and purchases to each of the directors must be disclosed, the interest charged, the balances left at the end of the year. So it's quite detailed. And all of that is coming from IAS24 key disclosures. Right? So watch for that. That's key management personnel, the compensation. Right? So there you must disclose your relationships, and we said paragraph 17 is the one we were looking at there, your key management personnel compensation. Short-term benefits, post-employment, which is your pensions, and any other pensions like share-based payments, etc. And if you look at your model financial statements as well, we'll just go back, we'll look at the table of contents for related party transactions, which is note 65, page 187. They give all of these disclosures as well. So you can see here related party transactions, the trading transactions during the year, who do you sell goods off, who do you buy goods off, how much are owed to or owed by related parties in the year, all coming from IAS24. When you go to the next page, key management personnel remuneration, IAS24, loans to related parties, IAS24 as well. So it is an important standard. You'll see it in every single set of financial statements. Keep an eye out for IAS24 related party. Right. So then there's all your disclosures, the description of the nature of the transaction, the amounts involved, all that we've seen already. So we won't overlap on that. So IAS24, it tells you how to determine whether a related party relationship is there or not. It tells you what transactions must be disclosed, and it tells you in what form they must be disclosed. So you'll see some past questions. You might be asked, is there a related party relationship? And if there is, what must be disclosed? So make sure you go back over those now and take a look at question pack 9 as well, which gives you small examples of applying your knowledge of IAS24. Right, so that was the last main topic in AC571. Next week then we'll look at a revision session and the exam overview.